All right, hopefully I've got my technical difficulties out of the way after that last video. I want to go over and talk to you guys a little bit about inefficiencies. So I mentioned this in the group earlier this morning, especially after a move like we had today, that I wanted to talk about price inefficiencies. So you have seen in the group that I've been very vocal about not longing this move here. Okay, after this, basically, not to be entering longs until the market decides what direction it's going to take. All right, because too many times after the move has happened, you feel like you need to make your move, because if this has happened, what happens if it keeps going up and it's up, 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 all the way up to 45 to 50 and you miss out? It's actually the biggest way of inducing FOMO is to have a massive impulsive move like that. And that's not by accident, guys. Like the people who have the deep pockets and control this market essentially know exactly what they're doing. It's done time and time again. And the reason it keeps working is because people never change. We're always going to be emotionally driven, creatures essentially. And the only ones who aren't like that are either the algorithmic bots that are literally computer programmed, just trading using mathematical systems, and professional traders who have done this for so long and are so conditioned to the movements of the market that they don't let it affect them. But even those people do. Everybody does. It happens to me all the time. You can't change the fact that you feel that when something big happens, you need to make a decision. Like, you have to decide there and then what to do, or else you're not doing your job as a trader. But that's not the case whatsoever. So, but I want to cover what an inefficiency is, and then show you a few examples of them. So when we talk about inefficiency, you have to remember that why do markets move in the first place? All right, so many people have different opinions on this, and some people believe that the market's just completely manipulated and that the chart doesn't matter. It's all done by a group of evil people who are controlling everything, and they make it move regardless of what happens. And it's just there to steal your money and make you feel shit. Other people will believe that the market moves based upon their whatever technical analysis tool they love, and if it does a head and shoulders, it's going to dump, and if it does, a bull flag, it's going to pump. And then, other people again think that the market, it's all controlled by institutions. You have to be able to spot the smart money and stuff like that. Like, to be honest, none of those things are fully true. Probably none of them are fully false either. There's probably elements of truth in everything. It's like anything in life. There's, it's going to be a combination. But what I believe and what makes the most sense to me is that the market's just a constant auction. So the market's always trying to find a fair price, a fair value. And every time there's a buyer and a seller, so it makes sense that it works in an auction format. To me, that's not even a theory. That's just fact, because you have an advertisement of price. And so if I advertise price, let's say I put an order in to sell at 38,000, that's advertising that I want to sell at 38,000, and you can come along and you can either accept that and buy it, or you can say, no, I don't want to buy it at 38. And if nobody else wants to buy it at 38, well, then there's no demand up there and the price will drop until there's a level at which people will buy. So to me, that makes the most sense. We're in some form of an auction. And then how that leads into inefficiencies is that if something is in an auction, it's either going to be at an accepted level or it's going to be at a rejected level. So there's two basic tenets of the market are acceptance and rejection. So the easiest way of seeing that is like what you'll see on the chart is this here. Let me just not extend that line. So you got a market which is doing this. You can ignore my shit drawings, but typical, like what we had today, that That's acceptance, okay? That's also called a range. It's called accumulation. It's called, consolidation, whatever you want to call it, or, or distribution, depending on what way it ends up moving. But all you need to know, and all I believe, is that means that buyers and sellers are basically agreeing that this current range or whatever it is fair value, okay? Then what happens generally is price will make a move. Let's forget about fake outs and things like that. We'll not talk about that right now, but let's just say that price moves, okay, decidedly out of the range and down, okay, and then does its usual move again. Now you're in another area of acceptance. And what this part in the middle is called rejection, okay? So even though price, don't get confused, that price went through that, yes, and price traded there, and there is price history there, but because it didn't stay there, we call that rejection, okay? It doesn't have to reject by going back into the range. It can reject by going right through it and finding another range. This is an inefficiency, all right? So anytime you have that, you could have a lot traded here. You'll have a lot of price action. You'll have a lot of people buying and selling. You'll have a lot of, interested parties, either institutions or retail or whatever, whales. They're either going to be buying or selling. Here is where a very quick move generally happens, just like this one. And then here is your next level of acceptance. These inefficiencies tend to get filled at some point, okay? So the reason why I said this morning not to be longing this is because there's a good chance that this will get filled, meaning that price will come back into this area and start looking and testing to see, was this really, a clean rejection, and was there really no demand here? Or if we crawl back down lower, are we going to find some demand and then eventually, make our moves the next way? Because if there is truly no demand here to bring price back up, we're just going to end up retracing back down to here where we know price will be accepted. Price will definitely be accepted here. So if we come back down here, we're just going to end up ranging at 35K again. We've only been up here for 24 hours maybe, not even, just coming up to 24 hours. This might have just been a deviation. Like if you look at this on a daily chart, that doesn't look great. It's pretty ugly. It's a big wick that we need to fill. Like we need to fill that wick tomorrow if we want to be bullish. But we can get trapped very easily into thinking on the wrong time frame. It's easy to look on a 1 hour chart or a 5 minute chart, or especially I trade short term. I'm on the 5 minute, I'm on the 1 minute chart a lot. It's very easy to, trick yourself into thinking things are happening that are just not true. So this inefficiency is looking like it's going to be getting tested. Now, I'm hoping that it's going to hold kind of at about 36,700 or so, down as low as maybe 36. If it goes any lower than that, I'm really worried. I'm not going to be bullish on this move at all. But I can go over that on one of the daily analysis. I'll probably go over it in tomorrow's daily analysis. So to look back at some previous inefficiencies, you're gonna, when we go through these, if you haven't seen these before, it's going to be really obvious to you, and it's going to become really clear what's happening when price moves. Okay, so like we said, I'll just pick out the most recent couple. Price can only do two things. It can either accept or reject. So you go from a period of acceptance, call it accumulation, call it consolidation, whatever you want, but price is happy to stay here. So for it to move out of that, something big has to happen. Hence, a large, low resistance move. Okay, price blasts up, and then it starts doing that again, accepting, and then blasts up again, starts accepting, and then starts to make its move downwards. All right. This is generally why when you're seeing, especially in a ranging market, you're gonna, there's like a saying basically, you don't fade the first pump. All right. So that means is when the first big move up happens, you don't want to start shorting that heavily, because generally in these markets, if it's done all this, all right, and it's made the big move up, it doesn't usually just make that one move. It usually does a second leg, and actually, generally, there's a third leg as well of some sort before it then starts moving down again. Okay? Obviously, that's not always guaranteed. Sometimes you can fully retrace. Like this is a good example here. If you look over this way, it can go up and straight back down. All right, but you know, the more you watch these, you'll see it takes a bit of nuance, but you can tell pretty clearly when it's making a move that's going to stick. Now, that kind of goes over what an inefficiency is, but you're probably wondering what use is it to you? Like where can you benefit from this? How can you profit from this? So take this one for example. What you want to look at is, all right, all this shit was going on here. I remember this really clearly. We had that big dump down and we had a massive move up. And I remember everybody was calling for this to be like literally calling for zero down here, thinking we were going to go and test like the old all-time high. Then we pumped back up and everyone was getting super bullish and saying, look at that move, look at this next move, this leg up. We're going like, we're literally going back to range highs, we're going to 45, we're going to 50. And everyone was calling this like a Wyckoff accumulation spring. And then suddenly we started retracing down here and everyone was getting a bit worried. And then we pumped up again into, and this was in a weekend, pumped into the weekend and everyone was starting to get bullish again. And we went on this absolute death march down. This was a really, really rough, like it was a Saturday morning, I believe, where I am anyway, I'm in European time zone. And it just went down. I think it was 18 hourly candles in a row, all red, until we eventually bottomed out. So at this stage, we had a dump down and we had a really fast, inefficient move up. Okay, so this was clear rejection, back up, and then into areas where we had accepted before. So we accepted, we went up, but not a big move. We accepted. You can see that we're basically filling in the gap really quickly. So we made a bit of a gap, we filled it back in, but then we went up again. This is a bullish move, okay? So you make a move up, you make your fast move up, you refill that fast move, but then you don't dump past it, you move up again. That's generally quite bullish. So you did get a nice little lift up to 35. Then we got a slow move down. But what this was doing, and it's obviously easy in hindsight, but what you can see now is we moved away too quickly from here and price just needed to retest. So price came back down, sold off the whole way. Everybody got very bearish here. Everyone sold down into this thinking, oh shit, we're going to obviously go lower. But no, price started accepting again. Turns out that this was a good low and it held and we moved up from there. So that's one way you can play it. This is why people say wait for the first retest of any big move. So if you had waited on this large move up and had patience, you would have got a really good entry here. Okay, so what you'd be looking for if you're going to enter there would be wait for price to give you at least one confirmation. So when it went down here and it took this big sharp drop down and then moved back up and started consolidating and moving upwards. As soon as I see this bit happening, we've got these 3 hourly candles in a row that are moving up, I'd be starting to enter longs because you've had 1, 2, 3, 4, you could say 5, or maybe even 6 of those wicks. You have 6 opportunities, 6 tries at dumping, none of which have even got close to this low. That's bullish, and you should be entering longs at that point, targeting, the local highs. So you want to be targeting these highs, which eventually we took out. But that's probably a topic to go into a bit more on another day. But speaking of inefficiencies, they also become targets for retracements. Okay, so if you're somebody who's wanting to trade both ways and you want to short as well as long, the best short entries are going to be mean reversion, which is basically coming back to an area of acceptance. So we've had acceptance here and we had a large move up. Okay, we had a pump up, that was a short squeeze. I remember lots of shorts getting liquidated because they were all really bearish from down here. They got liquidated on the way up here. And then price, continued on up and started doing its thing, but didn't accept up here and it dumped back in and suddenly we were in this range again. So for me, that's a sign to start looking for shorts. Look at how little time we spent up here. That was rejection. Back down here into this area. Right, okay, now we're looking for short entries. So if you're getting in short anywhere here, depending on your system, you might have got an entry here or probably here, or possibly even here if you waited for real confirmation of this next drop down and you entered here. But what's your actual target going to be? It's going to be to fill this gap, fill this inefficiency. So I'd be looking to take profit on a short around here somewhere, anywhere kind of anywhere in the bottom part of this candle. So as you can see, if you manage to get short anywhere here, you would have eventually got you got your take profit, and got out quite nicely. So if that was a scalp trade, like you could have been getting in at kind of 30, not really 35, but a bit less, maybe like 34 and a half. You easily would have got 34 and a half, and you would have got all the way down to 33. So that's a really that's a good move on Bitcoin. That's a substantial move. It's not something to be sniffed at, and it's a fairly, those trades, the more you do it, the more you check, the more you practice, you'll see they're fairly safe, especially in a ranging market, especially in a bearish market. In a bearish market, retracements of these happen like almost every one of them retraces, which is why, again, I'm slightly concerned of today's move, because we are still in a bearish market, in my opinion. It doesn't mean we're in a bear market fully, but everything has been retracing recently, so until that changes, I wouldn't be getting too bullish. You can see here, big move up, inefficiency, gets eventually retraced. And you'll notice, especially in a bearish market, it doesn't tend to just retrace, it goes beyond it. So if you want to take profit 1 and then take profit 2 further down to increase your potential profits, feel free to do it. That's something I do from time to time as well. But that was basically, overview of what inefficient moves are. They go both ways, up and down. So how you can use them is wait for it to happen. You don't, like, the chances of you being in a trade that ends up pumping, like this morning's one, we'll go back here. Like, yeah, maybe you got in here and it pumped up. That you might have done, and if you did, then great, take your profits up here. But the main way of playing these is to wait for the move to happen and then time your entry. So me personally, I'm looking to enter towards the basically us filling this candle up, kind of anywhere to about here. 36 is my cutoff point. I'm trying to get longs in here, anywhere down to 36, and that's for other reasons that I mentioned of why it's not, I don't want it to retrace this full thing, because basically if it retraces the full thing, then we're bearish again and we're probably heading down to 34, 33. My trade idea is that we're going to retrace the bulk of the inefficient part, and then we're going to kick on from 36, because 36 used to be a very key mid-range. So we used to have a lot of price action at 36. 36 used to be the big level to hold when we were ranging between 30 and 42. So that's basically why I'm looking for that. But whenever you're looking for it, if you're looking for setups, you want to wait for the inefficiency to be filled and then trade in the opposite direction. So if I see this come down, I'll just draw a little bit on it. If I see this come down, find my level around here, and then move back up again, that's great. If we do that, if we dip down here, hang around for a bit, and come back up and back in this, there's a very high probability that we're going to then go up and fill this inefficiency, because you can see here, this big candle down, again, it works both ways. That's an inefficient move. So you could get this type of move that goes up, and then at this point, everyone's calling for the breakout. That's where I'd be taking profits. And you could even see it do that. We don't want that. That's obviously going to be ugly and it's not going to look good. But these things happen all the time. It's if that came up in that sort of format, it wouldn't be alien at all. It wouldn't be like something that's never happened in Bitcoin. It's very, unfortunately, it's a very common thing. Or we could just break straight out, but Bitcoin tends to take the path that's going to screw the most people over. Don't let that be you. Enter at an imbalance and trade it back towards balance. All right. So I'll cover out one more time just the balance versus imbalance thing of how I would just generally take a trade if I was taking a short-term trade. All right. This works really well. This is why breakdown trades and breakout trades. God, it's pretty shitty. Yeah, you'll have to do. You guys get the idea. If I was taking a trade here, I would be waiting for the price to leave here and then waiting for it to come back. So if I wanted to do the mean reversion, I would let it break down, find this new range, and then when it breaks out, wait for it to retest here. Ideally, it would come back in and then out, and I would enter here, and I'd be targeting the top of this. I would only be targeting just to here. I wouldn't be trying to get the whole way up here or anything. You want to take this part of the trade because that's the part that has proven itself to be inefficient. That means that when it comes out here, it's going to break out. People are going to long it too early. It's going to come back. It's going to wreck them. Then people are going to short it, and it's going to turn again. Then when it makes this move, it's going to be a fast, violent move upwards to fill that inefficiency. If it doesn't, like the video I showed earlier where I exited my trade, if the price doesn't move fast and in your favor, don't be afraid to get out of it. You don't have to sit around waiting for price all day because, if you've got a rule set like I do where price should be pumping and dumping, then if it doesn't pump or doesn't dump, just get out. Or else you're just going to end up sitting in front of the screen all day waiting on a move that never comes. Like that trade I did earlier, I could still be sitting here waiting for that to do something. And you can see that obviously price is just accepting here, so it's not going to do much probably for the next like hour or so. Well, we're coming up to the daily close, so it might do something now. But basically, that was just an overview of inefficient moves, what efficiency is, what it isn't, and I'm going to post this in the channel now. Anyone who has any questions on that, put them in the crypto questions room. If anything I've said about inefficiency or those type of moves, if any of that doesn't make sense, if I've not explained it right, if it needs more clarification, just let me know. Pop it in the channel and I'm happy to answer it. Here we're going to do a video, long awaited. Everybody wants it. How are you going to get it? How to mark your levels. You see in some of my lessons I talk about balance and imbalance. In the previous lesson, lesson 10 in this series, we talk about how balance and imbalance, how they act and how you trade between them. But whether you use balance and imbalance or you use another method, essentially what you're trying to do is find areas of liquidity, untap liquidity, and find breaks in structure that need to be retested, and find entries using low time frame patterns such as the under-over pattern, which everyone should be familiar with by now, where you set a low, you sweep down through the low, you break back above the high that led to the low, and you retest. It's typically a reversal pattern. Same happens on the upside, where you get a topping pattern. Okay, so first you want to think about what is an important level. Important levels are the higher time frame periods of price action. So the highest time frame is always the most valid. As a short-term trader, scalper, day trader, whatever you want to call it, your highest time frame should be the daily. Weekly, obviously if we reach a weekly level, that's of great importance, but it's not going to happen very often. If you want, though, you go to the weekly and you do exactly what you would do on any time frame, which is mark order blocks, such as this. All right, you can see this because the last up week, the last green week before we broke structure, the weekly market structure level, which was here, this weekly swing low, because basically we had two weekly levels, which were here and here. So we had this low and we had this higher low. So we also broke the weekly resistance high. So we had set a new high on the weekly. So basically what we had done was set a high, set a low, made a higher high, made a higher low. So for this to continue as an uptrend, we couldn't break this level, and certainly we couldn't break this level. We obviously ended up trading through them. So the candle that led to the breakdown through this level, and certainly through this level, which happened to be the same candle, this up candle led to all of that breaking, becomes your weekly area of supply. So if and when, well, when, it is a matter of when, not if, we revisit this level, this is going to act as a key resistance, and you'd be looking to exit longs and probably flip short on any low time frame signs of distribution. But as that's a weekly, you can see it's quite far away. It's in the 40s. We're in the high 20s. It's not going to offer any trade setups anytime soon. And obviously, quite recently, we've already broken the weekly structure. And so we want to look at more of a up-to-date low time frame daily structure. You can see here, if you're looking at it from a market structure perspective, the next weekly market structure is here. This down candle that led to the entire bull run, basically. So yeah, 17, again, that's another key weekly level. And if we draw a demand block around that, you can see that it's basically between 17 and 20. And again, have your alerts on these for sure, but they're not going to offer trade setups, right? So to trade, we're going to clear all that and go to a lower time frame. But that shows you that, yes, it's always good to have those levels marked. But for day trading, you start on the daily. And we take a look here. So the first thing I'm looking at above should be very obvious to anyone who's looking. We had this low. So this was the key level that I'm going to mark. I'm just going to mark those market structure levels in white. You can see this is white, this low. We traded down through it. We bounced on the daily. We didn't retest it. We bounced up. We didn't test it. So this 32,933 is a big area for liquidity. And it's a daily resistance. So mark it as 1 day resistance. And also, you say liquidity. So there'll be liquidity resting above those highs because we came up almost and almost. So people are going to have set their stops above them. So it's a 1 day resistance plus liquidity. All right. So you want to find those supports and resistance that were last found as support or resistance. Find them that when they break, and then the retest is where you're either going to exit a long or enter a short. When you're revisiting that level to test, you want to go to a lower time frame, such as the 4 hour, 2 hour, 1 hour, to find more accurate entries. Basically what you're looking for there is a 4 hour, 2 hour, or a 1 hour order block. That is the most likely place for us to touch. So if we're looking on the daily, my upper bound limit would be here, which you can see is a daily block of supply, daily bearish order block, whatever you want to call it. This candle here, this up candle that led to all these down candles which broke the structure and eventually, of course, broke this structure as well. All right. you can mark this as a previous daily support. One day support. Let's do this 1 day sub. Just keep it short and simple. That's a 1 day support level, but we tore right down through it. So contrary to what people might say, just because we leave a long wick there does not mean that this is support anymore. It's not support. It's no longer support once it gets broken. So this is actually a sign of weakness, because I mean it should be pretty obvious when you zoom out. We tested it 1, 2, 3, 4, 5 times in this zone, came all the way back and went right down through it and swept all that liquidity. So that's not a good sign for an uptrend. If you're trading it as a range, you can see it as a sweep of the range low and maybe we bounce back into range. But also you have to remember that we're in a bear market and we're in a downtrend. So more likely than not, what we've done is we've taken out that support and we haven't had a strong bounce, which means this level is now weak. The demand that was at this level has disappeared. Look at how strong the bounces were. Even here, this bounce was pretty strong and we came for a retest, crucially held at a higher low, and then had a full, basically mini bull run after it. So far we've had very little impulse off it, no strong bounce. I wouldn't really call this much of a strong bounce considering how much liquidity it swept out. You have to remember the bounce we got here, bouncing up into this, that was not without sweeping any significant liquidity. We swept this low, yeah, but we didn't sweep these lows. We didn't sweep this low. And so getting a strong bounce off that was a good sign. We swept all of that right down to 25, swept all of this back as far as January 2021. So we swept out a year and 4 months of price action, and we got basically no impulse. So that's a clear sign of weakness. Now, if we can bounce and continue up, we do have untested supply. So we got this key level up here that we're looking at on a higher time frame as an area that needs to be retested. It's a bearish market structure break. We broke down again through here, the daily down to this level. So this key swing low before, the key low got broken, hasn't been retested. So before we go lower, if we do go lower, I'd be expecting this to get swept, this liquidity to get tested. Because we bounced up, we tried to retest it, we didn't retest it. We tried to retest it, we didn't retest it. So are we just consolidating and basing with a view to eventually taking this level, then going down? If we take that level and come back below and have a daily close where there's a wick above and a close below, very strong sign that we're going to go lower because we have retested that key level. But that would mean that you're you have a valid setup for longs. It doesn't mean that you go long right here, but you've got a clear target, and that's all you're looking for. You're looking for targets. So you want to mark your order blocks on your H4 levels, so your 4-hour candles, to try and get a better entry. So, sorry, do 4H, not H4. So what are we looking at here? We're looking at these levels. So we bounced up, so we've got these two highs. Do we have a structure level that we can bounce to? Well, you can see here on the 4-hour, this is the 4-hour candle that preceded the first break. So this 4-hour candle becomes your new order block. Doesn't mean you get rid of the one above, but obviously it's more likely, and we're going to test the 4-hour supply zone before we test this daily one. So here's a level that if I was looking at it and saying the line that's going to get taken is 32,933, that's going to get swept at some point. And more likely than not, we probably wick up as far as this block and reject there, because that's where the 4-hour bearish block is. So that's giving you a more accurate entry for your short, or a more accurate take profit for your long. So you've now got a 4-hour level that you can take. So we want to look at that. We've got a 4-hour block of supply. Do we have any 4-hour blocks of demand? Well, we're looking at market structure breaks. So we had this 4-hour block, which led to all of this breakdown. So this 4-hour level here led to the breakdown of all of this. So we had support here, which was an old 4-hour support level. H4 support. Which is here. We found support there, then we traded down through it. It acted as resistance, resistance and chop, 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 chop. Pushed up above it, came back down to it, found support briefly. We're now trading in around it. So it's certainly not a strong support. It hasn't fully flipped to resistance yet either. But it would make me feel that we're going to go lower before we go higher. So this 4-hour support level isn't a tradable level. And you can see when we do this, when we have all of this price action bouncing up and above and below it, you can invalidate it as a level of support and really as a level of resistance, because it sort of is acting as both, but it's just causing us to consolidate rather than have any impulse. So this swing low, okay, so this, which previously was a pretty strong bounce, then got traded through, has now become a gray area, a kind of area that's not got any clear impulse. So if that has become now a choppy consolidation level, you want to look lower. So where's the next 4-hour swing level that we can look at to act as a potential support for a bounce higher? Well, at the moment, we've got this low, swing low, which is the last attempt to go lower, which rejected and pushed us higher. It took us to break this level. So we had this previous 4-hour resistance level. There's resistance. We bounced up into it. We cleared out the liquidity above it. We came back below. We came down quite inefficient. So we have a gap down, which means the way I like to mark the gaps is this low here, and then we broke down from it, hasn't been retested. So this bigger block is considered supply, because as you can see, we've spent most of the time trading below it. We tried to get above it and rejected. So this is still a valid supply level. We can remove it because the entirety of the block is not valid now, because we've traded through it. We've traded all the way through it. So the block itself is no longer as relevant as what's inside the block. You started with this big block. We tested it. We went through it. We came back. You want to now get a little bit more detailed with your markings. So we have here an uptrend. We have lows and higher lows and higher highs, higher high, higher low, higher high, higher low, higher high, and then that gets broken. So that's why this level, this old H4 swing and a market structure break, because this was the low that led to the highest high, we then broke it, therefore it's a market structure break. Let me just mark it there. And we can remove this old high. And we look at this block. This is the last attempt for bulls, because this was a valid uptrend still. This was the last attempt for bulls to push higher before we went down and flipped us into a downtrend on the 4-hour. So we look at this, and we've got this now. Now we're getting a lot more accurate with our targets. So for me, what I'm expecting to see is this level to get tagged and probably to wick into this block and then reject. So there's a clear area for short entries and take profits on longs. your daily support is stronger than your 4-hour resistance. All right, so this block, which is here, remember that the higher time takes precedence over the lower time. So this is a H4 order block and a H4 swing low that was a market structure break. But we're heading down towards daily support. All right, if we go back to the daily, we've old daily support there. Right now, because obviously the more recent price action takes precedence, so again, I would move this up to, let me see if it's gonna, God, it's a bit slow. Go to here. Here's our daily support level. So there's our latest daily support. The daily support there, because we had all this chopping around, moved down, held here, broke up, and took out some highs. So this is, for now, daily support, and then obviously an obvious daily support down here. So what I'll be looking at is a retest and a revisit to this daily support to give us a bounce into the 4-hour area of resistance. If you're looking at daily support, you want to look at a low time frame entry on the 15-minute or whichever time preference you prefer, 15-minute or 5-minute, as a good place for an entry. So where we are right now is not really a tradable zone. This here, these lows that are being set here, and we're chopping around, even if you take them out, say you come down and you sweep this out and you bounce back up, that doesn't offer a very good valid setup for a long because you haven't tested the daily support. So even if it bounces up here, will it reach all the way up here? Probably not. Probably more likely that we bounce down up to here, trap some people, then we tag the daily support, then we get to move to daily resistance, 4-hour resistance, sorry. So if we go, keep doing that, I keep writing H4 instead of 4H. Get my Coinbase chart back. I'm only using the, even though I trade on FTX, I'm using the Coinbase chart because I have lots of notifications and alerts on my FTX chart. It doesn't really matter. The levels are broadly the same. It's key lows, key highs. You're not trying to enter to the dollar. There's obviously a few dollars difference between each exchange. Don't worry too much about that. So if we go to the 4-hour again, now we're going to look for a better entry at this daily support level. So what have we got down here? We can either sweep this low at the daily support level or hold above it. Making a higher low is completely fine. So you want to look at a previous down candle, which then led to all of this up move, which is here. So this was, we bounced down, sorry, we went down, we bounced up. We came back for a retest. We bounced here. We had this attempt to go lower, and then there was no more red candles all the way until we broke structure. So you can look at this here as a potential area of support, meaning that on the H4, so on the 4-hour, we have this bullish order block, demand zone, whatever you want to call it. Also, we've got a couple of lows that are set here, so you know there's going to be stops built up. So if I saw a move into here and a bounce back into range here and a 4-hour close, so another wick. If we have a 4-hour that's a wick into this and closes back above, that's the first signal to play a long. All right. You want to then look for an entry on that long on a lower time frame. And for this demand to remain valid, you don't want to see us wick all the way through it. If we do all the way through it and back up, that invalidates this as demand. Demand should hold and bounce us, the same way that strong supply will hold and reject us. All right. So to make it clear, you want to wick into it and get a strong bounce. That means there's resting orders. That's resting liquidity in this area. If it wicks into it and strongly bounces and closes a 4 hour back above in the same 4 hour candle, good sign. If it goes all the way through, even if it bounces, if it goes all the way through and bounces, it's not a great sign, because that means this demand wasn't true demand. It had to reach all the way down closer to the daily support level, and then it's more likely that we actually come back down and really test that daily support. Then we get the strong bounce, and then we go up. Because if it does this, long wick down all the way through your block of demand and bounces up, probably a trap, because people will go long, they'll set their stops, we crawl back down, we sweep out the real demand into daily support, then we get the bounce. I do fully expect us to get a bounce off daily support here up to 4 hour resistance. Okay? I think that's a pretty reasonable expectation for a continuation of this kind of choppy inside price action. And so when you're actually looking to trade that, you can go to your next preferred time frame, which for me is the 1 hour. Some people like the 2 hour, whatever. It's just a personal preference. It's not a big deal. And start to look for some of your price action patterns. So here we had an under over, low, sweep of the low, break back above the high, this high, which led to the low, breaking back above it, retesting and holding, coming up, breaking it conclusively. So we had a couple of wicks above it, then we broke it conclusively. So this area is a strong area of demand, but it's also a completed under over. You can see that. You could either say completed here. I don't like to do that with wicks, but certainly when we did this, you consider this as completed. Okay, either here is your shoulder or here is your double confirmation of your shoulder. Sorry. The main point of this is that this is a confirmed completed area of demand, meaning this entire block, you don't need to worry about the head and shoulder of it anymore. This entire block is absolutely demand. Okay, so if it's demand, and if it was demand on the 27th and 28th of May, when you revisit it, it should be stronger demand if we're going to get a bounce to create a higher low. Meaning, this block is still valid, that if you come into it, you should get same type of pattern, but a stronger bounce. It shouldn't have to go searching all the way down into it, especially when we've set these this low, and we've got some liquidity to sweep out. So now we're getting a lot more close to getting exact levels that we want to see. And remember that all this it's all happening within the context of a daily support level. So if you look at this broader zone all the way down to the 28 level, you're looking at it as a daily wall of support. And we're trying to bounce to a 4 hour area of resistance. So the way of viewing it, if you view the daily, which is here, 28 itself, and plus everything that happens up to it, think of it as a wall, okay? We've got a wall, and just for argument's sake, I'm going to draw another block over it. And imagine this full thing as the wall, and you've got your darker green for the top half of the wall. Imagine the price action that comes into it on the 1 hour, or even on the 15 minute. You've got a daily wall and you've got a 15-minute attack on the wall. So this is all happening on the 15-minute down here, all right? Whatever happens, however choppy it looks, doesn't matter. The way you've got to view it is the wall is stronger at the start and gets weaker towards the end. The further into it you go, the more likely that the wall is going to break. The price action on the 15-minute is somebody shooting at a wall with a gun. So imagine the wall is a concrete wall, or a wall made of block, and it's 2 foot thick. Okay, imagine a wall that's 2 foot thick and you're shooting at it with a gun. The 15-minute price action is the gun, is the bullets, the ammo, getting shot at the wall. The shots will absolutely make some cracks and holes and make some impact and dents and take some chips out of the wall, but they should not go through, because 15 minutes is not enough to break a daily. All right? So if you're looking at it from that frame, the daily support, the daily wall should hold. If this support level you're talking about was a 1 hour support level, which let's say something like this is a 1 hour support level, or maybe even a 4 hour. It's not a daily. If that's a 1 hour support level and price comes down to it, how much confidence would you have that this area, this block, let's say from this old order block all the way to the bottom of this wick, so here, bottom of this wick, and this block, which has already been tested twice, and we all know that the more times you test something, the more likely it is to break. This 1 hour block that's getting attacked by 5 minute and 15 minute price action, that's like a wall that's 4 inches, 6 inches thick, and you're shooting the same bullets at it. Which is more likely to break? Obviously, this wall. So what you need as a trader is patience, that when we reach your thick wall of support, which is essentially big players, heavier hands than you, whales, market makers, institutions, whatever, they are all setting up to defend this level. They're not going to defend this level, certainly not with any force. So wait until you get into the area that you know is daily demand or daily resistance, but in this case demand. Daily demand, and it's coming down on low time frames. So in the 15 minute, it's putting in a bottoming pattern like this. If you see this and it's on a 15 minute and you're into a daily demand and you're not breaking too far into the wall, that's a long signal, okay? And so your initial trade is going to be something like trying to break no more than half of this demand. So this, from the 4 hour order block that we marked, which is the darker gray, or the more, it's not even darker, but you understand, it's the overlapped green. And then you've got your entire wall, which is right down to the bottom of the wick, which is the entire daily demand. If we come down and less than halfway through it, and we bounce on a low time frame, that's a sign that the low time frame 15 minute price action, I'll just go with 15 just to be clear with it. The 15 minute price action on here is not enough to break the daily wall. So, especially when you have targets above, which are here, as you can see, a very clear swing high. So let's take a look at it on is it a 4 hour swing high? Yes, because we took out the low. So we had a bounce here, and on a 4 hour, it broke down and swept out the low. So you can call this a 4 hour swing high. It's obviously a swing high on multiple time frames. It's a 4 hour swing high. It's also an area that we're very clear that there will be liquidity resting above, because anyone who's gone short on this breakdown will have put their stop here. So that's an area, that'd be what you call your target 1 for a long. Target 2 would be for here, for your market structure break retest. Target 3 would be your block of, your H4 order block, which is your supply level. So if you get your bounce down, the first thing you're looking for is this swing low to get taken out. So this is like let's call it a H1 swing low. When that gets swept and we break back, you don't have to break above it right away, but you need to go through it, set a high, break down, break back above the high. A very simple pattern. Just keep an eye out for your pattern, and then enter on a successful retest. You want to be getting long somewhere in here. If you can get a bit of your long on at the top of the wall, then great. If not, don't worry about it. The main thing is, will this demand of the daily, will that hold? Then the last thing you want to see is when we break this, and we get our market structure break, and you can get entered in here, somewhere around there, or anywhere in this area. Let's just go right in the middle of it, just to be clear. First, drag your tool to the key level, so your daily structure is right the way down here, and then move it up. So your first target's 1.42, your second target is 1.88, your third target is 2.11. So there is a valid trade there. To me, that would be more of a swing trade, and it's not as tight or accurate of an entry as you could get if you were trying to scalp it. If you're trying to scalp it, what you want to see is, I'll remove this and I'll remove this. Your main thing you'll want to see is a sweep of this low, a second stab into the block, a strong break back above, a retest that comes back above, and another attempt possibly that gets above. And then we start to move up. If you touch down into this area of demand, you break structure bullishly, you try to go lower again, it rejects. Certainly if you get another one that rejects. Anywhere in this price action you should be preparing your long. If you want to wait until we break back up here on a lower time frame, 5 minute or 1 minute for another pattern on an even lower time frame, you can then start to declare this as your low if you're looking for better entries, which would be a break above here. That's your first sign. Break down, break above. And especially if there's a close, a 1 hour close above this level, anything that happens after the retest is just choppy action designed to stop you, to get you to panic. Look here, for example, and this is where looking back can help you in looking forward. You see the low, we sweep the low out, and we break back above here. You can see this high, which led to these lows. We break above, we come back for retest, we come up again above it, we retest again, we come up again above it. So you get multiple opportunities to declare this as reaccumulation.